Let's continue the top story from yesterday. GDP expanding in the third quarter by 3.5%, showing a bounce back in consumer spending. But how much of that bounce was spurred by government programs and incentives? Joining us now from Newton, Massachusetts, is Peter Cohan, president of Peter S. Cohan and Associates, also author of You Can't Order Change, story about Boeing's leadership. Peter, good to see you again.
Thanks, Brian.
All right, so here's the point that I made on my blog and on the show yesterday, and tell me what you think about this. Forget about the percentage gain of 3.5%. Economic output on a dollar basis rose $112 billion from 2Q to 3Q. However, we have spent $173 billion in stimulus money so far. I mean, you could come to a conclusion that we're getting a 65-cent on the dollar return on stimulus, could you not?
Well, you know, that's an interesting point. It's very different when you're making government spending during a healthy economy, in which case you get about 40 cents on the dollar. And when you're making government spending during a depression, which is basically what we're in, you get $1.50 in return. And the difference is that you have no private capital going into the market, so you need something to jumpstart the patient. The real question is, what happens to jobs, obviously? And the second big question is, what happens when you stop applying the paddles to the heart? Can you get the natural forces in the economy to get going again and take up the slack?
Let's put the brakes on what you just said, because you said we are in a depression.
Yes.
We're still in a depression.
Yes, I mean, if it weren't for the government spending, things would be an awful lot worse. I really don't believe we would have had any economic growth if it weren't for all the government spending and, of course, the bailing out of the financial institutions to the tune of $23.7 trillion. So, I mean, if it weren't for that, I mean, if we were not in a depression, then at this point, inflation would be wildly out of control. I mean, we put so much cash into the system, so much debt into the system, that if it weren't for that, we would have wildly out of control inflation, wildly out of control interest rates would have to rise. I mean, there's a lot of things that would have to happen. But the fact of the matter is we have 7.2 million unemployed. We need to start creating jobs before we can get the economy going again. And that could take 2 to 3 years if you compare it to the last recession.
Well, then the question is, how do you spend more money by the government? Where do you spend it? Because Congress is talking about extending unemployment benefits. By some estimates, 99 weeks of unemployment benefits is how much some people in high unemployment states would get. Is that the right solution, to just keep people giving them unemployment checks?
If you analyze, I don't know about unemployment checks. I mean, it's certainly going to be helpful for people, the 7.1 million people who are unemployed, or the 7.2 million who are unemployed. But it seems like if you analyze the Q3 report, what you see is that you got 22% growth in people buying cars and in housing because of the cash for clunkers, which is $4,500 credit, and the 8,000 first-time home buyer credit. Those seem to have a significant payoff in terms of economic growth in the third quarter. So maybe that's where you focused your government stimulus spending.
Yeah, in fact, of the $112 billion that I referenced in total dollar value economic output increases 2Q to 3Q, $36 billion or so of that was related to cash for clunkers, so a full third, which of course begs the big question again, kind of following up on Dagan's point, what the heck is going to happen when these programs end?
Well, you know, this is the big question, is how do you get the private sector to pick up the slack? And I really don't know the answer to that, but I definitely think that things would be a lot worse off if they hadn't been spending that money. And I think, you know, that cash for clunkers and the first-time homebuyers credit seem to have so much of a positive effect. It seems like you would want to try to do more of that and try to find other programs like that which seem to have a pretty good bang for the buck. But I really believe that eventually you have to have the private sector kick in.
But, Peter, at what point do you get no bang for your buck with, say, a first-time homebuyer tax credit? By the Brookings Institution's estimation, it actually cost $43,000 per home because more than 80% of the people who bought homes were going to buy them anyway. So you're pulling demand forward largely. At what point does it just not matter about whether you extend the homebuyer tax credit or not?
I agree. I mean, all of these things have the potential to sort of run out of steam, and you have to start finding new ways to spend money. But, I mean, to me, the key issue is if we've saved 650,000 jobs, we still have 7.2 million unemployed. I mean, that's, only about 8% of what it would have been without that. So we definitely need to get the private sector getting those animal spirits going again and starting to invest and starting to hire. And I have heard anecdotally that some companies are starting to hire back because their inventories are getting depleted and they need to produce more. So I'm hoping that that will become, a little bit of a match that lights a bigger economic fire, because we definitely can't keep spending government money. Yeah. We're going to reach our limits, and we need to get private sector to step in.
Yeah, and in my analysis, we didn't even factor in the interest on any new debt or treasuries that we're issuing now, or the inflationary impact on the dollar, but we'll get to that next time. Peter Cohan, thank you very much.
Thank you.
All right.